In expecting a deal between the US and Iran, markets were upbeat in the last couple of months. Oil prices came down and equity prices gained momentum. The preliminary deal is there, and it seems that the Strait of Hormuz is going to open, and therefore we prevent a shortage of physical raw materials. That's good news, and therefore it was the right direction as markets went. Now, looking forward, it seems that a huge amount of the positive news are built in already, and we do not expect another relief rally to come. The downside, on the other hand, is there, and if the deal falls through, there might be an abrupt reaction on markets, because then physical shortages and all of those negative news will come through immediately. On the economic side, this behavior of the last couple of weeks is in line with our previous scenario, so we did not have to change our view again. There is one exception to this, and that's the forecast for the euro area. And this is because we had new data coming out of Ireland, where the first quarter was pretty negative, and this caused a downward revision of our overall euro area forecast from 0.9 to 0.5%. Apart from that, we expect that with oil prices being around $80 in the next couple of months, that the situation on the economic side is going to improve. Oil prices being down again also means that inflation is likely to come down as early as the June figures will show. With this, we think that recent hawkish remarks, both from representatives from the ECB and from the Fed, will disappear. And with this, we also think that bond markets will react to this fall in oil prices, what we have not seen so far. So, with the dot plot at the moment showing rate increases till the end of the year by at least half of the FOMC members, we do not believe that this will take place. Our forecast for the Fed is a rate cut by the end of the year and not an increase. And also for the ECB, with inflation coming down, we do not see the necessity of increasing rates again. So we have stable ECB rates till next year, when we see in the second half a reduction of this previous increase of rates. Now, talking again about central banks. We have the new Fed governor, Kevin Warsh. And he did not say much about the outlook of monetary policy, and that seems to be the new style. He wants to be less transparent, and therefore he ends a long-lasting history of central bank communication, what was to go to further openness and being more transparent. He wants to make the Fed less transparent with his 5 task forces. With this, we think that volatility in the market, which will have a harder job to predict what's the next step by the Fed, with this, volatility is likely to increase. And furthermore, it might be easier to have political interference in the Fed. If you're not transparent, it is easier to do some things behind the scenes. And this might undermine the view of the markets of the independence of the Fed. With these trends going on, we think that at the end of the day, the recent strength of the dollar will come to an end, and we expect a depreciation of the dollar in the next couple of months.